Good morning. Today's December 22nd, and I'm on a talking shop call with Nick Mastrandrea of Markettealeaves. So Nick writes a blog, Markettealeaves, and the address is www.markettealeaves.blogspot.com. And Nick's probably one of Nick's greatest strengths is his insights into market correlation. And Nick has been trading for a long time, and I learned a lot from Nick about how the dollar is going to affect crude, and how these intermarket correlations are going to affect other markets. And I don't want to steal any of Nick's thunder, but I just want to thank you, Nick, for jumping on this call today. And I'll turn the mic over to you, and maybe you could introduce yourself.
Thank you, Carl. I appreciate it. I appreciate the opportunity to discuss Markettealeaves with all the subscribers of Sceeto and whomever else encounters this. Basically what I do is, again, as you correctly guessed, I have been trading for quite some time. And at one point, just to give you some insight, at one point I used to have a NASD Series 7 license. Currently I hold a New Jersey Life Health Variable Annuity Authority. But I've been trading now for over 20 years. I started out in the early 1990s, before the internet days, if you will. And one of the things that I came across during the course of my trading ventures, if you will, was how markets are correlated. In other words, how do they interrelate with one another? And one of the things that I've done, I guess, a few months back, is I started a newsletter called Markettealeaves. And what we do is on a daily basis, we pretty much dissect the markets in terms of how these various commodities or futures instruments are correlated or not correlated with one another. And typically what we found is that on days that the markets were not correlated, it didn't necessarily go according to plan, unless, of course, there was some geopolitical event or some political mechanism that drove the market higher, et cetera. I mean, those types of things can happen during the course of any trading day. But typically what we found is that within the 80 to 90% range, when markets were not correlated, it didn't exactly go according to plan, if you will.
So Nick, can I jump for a second? So are you saying that, like, so what you've seen just from your trading and your ongoing intermarket analysis is that if the markets are correlated and they're following the market correlation rules, it's a good trading day, and if the markets are not correlated and they start to get chaotic, it's a good time to pull back? Is that the takeaway?
Yeah, pretty much, yes, it is.
All right, thank you.
Because what we found is that if it's not going according to plan, something will happen during the course of that day. You know, doesn't necessarily make any rhyme or reason, but something will happen during the course of that day, and all of a sudden, it will not go according to plan. And we've seen this time and time and time and time and time again. So that's kind of what the takeaway is.
So then, just to jump ahead there, I see what you're showing here on the conclusion. You actually, the first statement or the first sentence in your conclusion is you're explicitly saying this is not a correlated market.
That's correct, yes.
So the inference there is that traders should be more aware. This may not be a great trading day.
It absolutely is correct. Okay.
I didn't know that. I'm glad I talked to you today. That's really helpful for me, because what I see also is I see times where I'm like, this is an easy trading day and I'm going to be more active, and sometimes I'm like, this is noise. Like yesterday afternoon, I'm like, don't bother. And that for me is a great lesson to say, don't bother, just walk away.
Exactly. I mean, it was not a correlated market. It went into the trading day not being a correlated market. We all kind of knew what happened Thursday evening with the House of Representatives, whereby they couldn't get a bill passed, they didn't have enough votes, etc. But I guess the impetus of that was also what happened in Asia. I mean, the Asian markets all closed down, and they closed down dramatically. All right, Europe followed suit, and basically, as I'm looking at it now, I don't necessarily judge what goes on in Asia or Europe. I use that as a guidepost, if you will. It's just another clue, another tea leaf, if you will, to say, you know, what could happen, what may happen, what may not happen. But I also take a look at what the futures are doing in terms of the U.S. dollar, in terms of the financials, in terms of energies, etc. And if it's not correlated, it's telling me loud and clear, you know what, this is not a correlated market.
So then
traders proceed with your eyes wide open, because it may not necessarily be what you think it's going to be.
So then how many markets do you actually like monitor, actively monitor in markets for your like global map of web connected or interconnected markets?
Well, basically, I take a look at the financials, specifically the U.S. dollar, and in terms of financials, I take a look at the 30-year trading bond because it's been proven very, very reliable over the past. I also take a look at crude oil because it's pretty much a universal commodity that we all need and use at one point or another, but it's very, very visible. When we go to a gas pump, you know, we see what's going on with oil prices, etc. It's something that anybody could really understand. I also take a look at the indices, specifically the S&P 500, again, because it's been proven very, very reliable, and also gold, because gold is in essence, the universal hedge, if you will, against everything. You know, anything chaotic, anything geopolitical, etc. Gold is universal in that regard. So basically, those are the major ones that I take a look at. And ironically enough, Carl, over the last, I don't know, 20 years or so that I've been doing this, I mean, those things have come up time and time again.
When they say those things come up time and time again, is there like a if you're looking at a 20-year span of analysis, do you say that it comes up time and time again and it ebbs and flows and it's good for like 2 or 3 years, or certain correlations come in and out? Like, what is the lifespan of the correlations?
Well, the correlation for us is what we do on a day-to-day basis. I mean, it's not necessarily something that we could turn around and say 2013 is going to be a great year, okay? You know, because of all these different factors. Or 2012 is going to work out to be this type of year, you know, based upon these factors. Because the reality of the matter is we don't know. It's all going to be dependent upon not only what these particular commodities are doing over the course of time, but also what happens on a day-in, day-out basis in the markets themselves. You know, are we going to have a good jobs numbers report? Are we going to have, is the FOMC going to continue to lower rates, or are they going to raise rates, et cetera? And all those things have an impact, without doubt.
Now, what about, like, let's say a correlation that you've been monitoring for 20 years? Has the behavior of any of these correlations changed, where you say the core rule set or the core insights or rules of thumb that we have for these two markets, the way they correlate, that has shifted over the last 20 years?
Well, I can tell you this is a fact, Carl, just as a case in point. I mean, when I started tracking gold, gold was trading at less than $50 an ounce. Look at it now. I mean, it only goes to show you that the markets have become, over that period of time, much more volatile. And clearly, yes, there's always an inflation rate, you know, with any commodity, if you will. But, you know, clearly when it goes from that level to where it is today, it tells you that there's a lot of risk factor involved, et cetera. But it also tells you that this is something you need to be very, very mindful of, because this will change on a day-in, day-out basis. It should correlate with the financials. It should. In other words, there's an inverse relationship. If the dollar is going up, gold should go down, and vice versa. All right. Same thing with oil. If oil is going up, the dollar should be going down, and vice versa. So it kind of gives you a clue as to what could potentially happen during the course of that trading day. What we try and do is, and what I try and do with Markettealeaves, is to make either novice traders or even those that are more experienced and want to learn something more about market correlation, try to give them an insight as to what could happen, and also proceed with your eyes wide open.
Actually, Nick, you bring up an interesting point, because, you know, just from my seat at Sceeto, I talk to traders all day long. I talk to novice traders and I talk to experienced traders. And I ask everybody, like I ask the standard questions over and over again. I'm always taking like an informal poll, you know, what's your profit target? How do you set your stops? You know, what are your rules of thumb? And I almost always ask every trader I speak with, do you use intermarket correlations? And about a third of the traders do, and about 2/3 do not. I don't, and I don't because I'm lazy and I don't really have it ingrained yet in me. And so when you say experienced traders can learn from you, there are, I would assume that 66%, let's say 2/3 of experienced traders are out there doing a great job, yet they're still not using this additional insight of intermarket analysis, either because they haven't been trained, or they're like me, they're lazy, or, you know, there's a combination of it. And I think that your blog and your offerings can offer that too for the experienced trader who just says, oh, this is another piece of information that's available to me at my fingertips. Is there
No,
like?
that's that's great. No, that's great to hear. That's Carl. That's great to hear. And I would have to say that, thus far they've been extraordinarily lucky, if you will, for lack of a better term, or they're that experienced of a trader that they know their charts very well. They understand patterns of what that particular commodity will do. And as you know yourself, I mean, each and every commodity, each and every thing that you trade, regardless of whatever it is, it seems to have its own personality, its own characteristics, etc. And, over time, traders become accustomed to that. They become accustomed to seeing certain patterns of familiarity, if you will. And, they know. To them, it's like second nature to them that they know. But, again, they could see a certain pattern during the course of a trading day, and then all of a sudden, some announcement will come out, and then, what happens to the market? If they're away from their screen for 5 minutes, 10 minutes, etc., what could happen? Case in point, and you pointed this out yourself. You opened up a discussion on LinkedIn regarding what happened to the S&P 500 Thursday night. Thursday night, I mean, everything looked hunky-dory and looked like everything was going to go great. All of a sudden, the announcement comes out, and then what happened to the S&P market Thursday night? Now,
Yeah.
if you're not actively watching that, and you're a night trader who likes to trade PM hours, you know what? You could have lost a heck of a lot of money on Thursday night.
Yeah, I think that swing trading is very. I think that it's funny because I really believe day trading is conservative and swing trading is risky because of that. Like that's case in point. And I mean, if we get time to it during the call, we'll get it up. And if not, so Nick, is there any examples that you can show us?
Absolutely. What I'm going to do is I'm going to bring up NinjaTrader because, as you know, I use NinjaTrader. And what I want to do is bring up one example, just a simple example to give someone who wants to understand market correlation, give an idea of how it could potentially be used during the course of intraday trading. Now, as you know, I mean, I'm an intraday trader. All right. In other words, I trade during the course of a day. I'm a day trader in that respect, but I'm also a trend trader. I'm not very big on scalping. Scalping has never really been one of the things I advocate doing. I will do it on occasion, if I see an opportunity, but it's not something that, for me personally, I normally advocate. I don't, okay? So here what we're looking at is we're looking at a Sceeto chart of the crude oil contract, the February crude oil contract, and we're looking at it on a specific day. This day happens to be the 18th, which was this past Tuesday, all right? And what we see is, and as I point out during Markettealeaves in the course of my newsletter, I've stated, look, oil typically does something, either long or short, around 9 a.m. in the morning, okay? Now, if I take a look at this particular hash mark over here, or this particular bar, it's around 9 a.m., all right?
Mm-hmm.
And in addition to Sceeto, I also use something called the Darvis Plus box. The Darvis Plus box basically measures short-term resistance and support levels for any particular commodity that a trader is looking at or trading. I take a look at it and I say, this looks like it's going to go long. However, there's something else that's catching my eye over here too. I'm looking at this, and the timestamp on this is 8:20, and it looks like it's gone to a high of 88.34. But when I take a look at this, it's telling me, okay, well, it's 88.04. Basically, for me, when I look at trend trading, I like to look at things that have either appreciated or depreciated by 50 ticks or more. All right.
In the crude, or is that 50 ticks per market?
Well, that's typically it's crude, and,
okay.
And I'm using crude as that particular example. The reason why is because, again, experience has taught me that the longer the downplay you have in terms of number of ticks involved in a particular trade, the longer the trend is. All right. As case in point, we take a look over here at 9:04. It's trading at a high of 88.34, and we take a look at 10 a.m. It's trading down to 87.66. That is a significant depreciation, which also tells me something else too, that this has a propensity or the possibility of increasing dramatically. And if we take a look at what happened after this at 10 o'clock, look what happened to oil.
Mm-hmm.
I mean, it increased significantly, which gives me a good, I guess, inkling or insight as to what the trend is going to be. And again, I'm a trend trader. I'm not necessarily a scalper. But the significance here is this, in terms of how this works with market correlation. All things in the markets, if we take a look at
Connection lost.
Predicated upon the financials. By the financials, I mean, what is the U.S. dollar doing? What are the treasuries doing, etc.? Those types of instruments. And the reason why that is I can go into a history lesson, which I won't bore anybody with, but the reason for that is, long and short of it is, the U.S. dollar is the de facto reserve currency worldwide. It's been that way since 1944. Because the U.S. dollar is guaranteed payment by the United States government, and it's probably the only currency on planet Earth that does that. But be that as it may, I mean, that's kind of what it is. That's kind of an unwritten rule, if you will, or written rule. But we don't necessarily trade the dollar, because, I wouldn't recommend anyone do that. If someone's going to trade the dollar, I would say do it vis-a-vis an ETF, do it for something that is very long term. So it's not necessarily something that you intraday trade. However, you can intraday trade the Treasury bond. Right now, if I were to take a look at another contract called ZB, which is a 30-year Treasury bond, and this is the same day, it's the 18th, Tuesday the 18th, at around 9:20 in the morning. Now, what do I see on this? I see that this has hit an intraday low over here, 146.23. I also see as time goes on that, wow, it hit an intraday low of 146.23. Mm-hmm. Typically, whenever the Treasury bond hits the lower end of a Darvas box like this, what it will typically do is advance. And if we take a look at this, we can see that this clearly has advanced. How can I use this in my trading? If the Treasury bond is going up, it stands to reason that oil is going to go down. If I take a look at what happened right around the same time, 9:20 a.m. in the morning on the 18th, look what happened to the price of crude. Dropped dramatically. Yeah,
what's interesting is you're using range bars. So for folks whose eyes are not acclimated to that, I think from 9:20 to 9:57, which is 37 minutes, or 10:02, call it 40 minutes. That whole drop is just done in 40 minutes. It may look like a lot of bars, but that's a little more than a half-hour move.
Yeah, pretty much. But typically this gives you some insider clue to say, okay, well, this is going down. Now, the 30-year Treasury bond could serve, for lack of a better term, as confirmation. We see that this thing started at 9:20, and then all of a sudden we see a double bottom over here at 9:45. So at 9:45, if I were going to take this trade, I would say, you know what? Let me take a look at what's going on with crude.
So actually, Nick, can I jump in for a second? Even without looking at the crude chart, if you were just looking at the financials from that one chart, can you say, oh, it's time for me to go look at crude? Did you need to monitor crude throughout this, or did you just need to say, oh, I see something here, I want to jump over to crude?
Well, no, you could do it. In essence, a trader could do it either way. They could turn around and say, hey, you know what? I really think that the bonds are going to go up. They could have taken a trade. They could have taken a trade right here. I mean, typically, if I'm trading the 30-year bond, I'm going to go one tick above where it's trading at. So I would say, all right, you know what? This looks like a good long play. I'll go long 146.24. Now we see that it advanced to 147.02. Now, here's the significance regarding Treasury bonds. That may not seem like a lot. In essence, it's about 11 ticks. Now, if you're trading any other commodity, you would look at it and say, oh, you know, it's only 10, 11 ticks. But be mindful of one thing. Each and every tick on the 30-year Treasury bond is worth $31.25. So if I went long and I actually increased by 10 ticks in the course of this trade, if I'm trading one contract, that's $310.25 for one. If I'm doing two, well, we do the math. It's double that amount, and not a very significant amount of time either. I mean, this thing went north, pretty quickly for maybe 40 minutes or so.
Yeah.
Not really a significant amount of time. It's not as though I gotta watch my screen all day. In reality, you don't. And if you're a good trader with a good trading plan and good trading rules, I mean, this should work out very well for you. Or I could have said, hey, you know what? It looks as though the CL, the crude contract, is really going to go low. I could have turned around and said, maybe in 9:45, you know what? Let me think about going long over here, or short rather. So you could have went short over here at 9:43 and picked up something, or you could have said, hey, you know what? I really think it's going low because of what I'm seeing in terms of the trend. The Darvas box is also going low, which is telling me something else. So the trend is down. So I could have turned around and went short here.
Oh, so that's how you use the Darvas box? You look for lower lows or higher highs to determine the trend?
Yeah, you could do that. You could do that with a Darvas box because what it's showing you is what the trend is. It's going lower. It's going lower. It's going lower. It's telling you right then and there, hey, you know what? This thing is going to go low. So, and I don't argue with that because typically this has been. It's not Darvas boxes are not erratic. I mean, they trade with a trend in mind, if you will.
Mm-hmm.
So that's typically what I use a Darvas box for. And you can see very clearly this thing is definitely going down. Another thing that clues me in, and again, this is very much Sceeto related, okay? If you take a look at this quadrant over here where you have green, it looks like it's going up, but then it turns red, then it turns green, then it turns red. And when it's erratic like that, it's telling you something. What it's telling you is, I can't make up my mind. And typically when any commodity can't make up its mind, if it's already hit a high for the day of 88.33 or over here, a high of a day of 88.37.
Yeah, and I noticed on both of those pivots you have buy programs wanings, which is the BPW, which was published by Sceeto. And the buy programs waning, for folks who don't know, is buy programs waning is specifically that. The buyers, the buy programs that push the market up, right there at those white BPWs means that those programs were waning. They were getting tired.
Exactly.
At those highs.
Exactly, and basically what it's saying, look, I've gone as far as I can go, and you know what? For at least for this portion of the session, I'm not going to go any higher right now. So those are ways that traders can utilize these tools to say, you know what? This thing is going down, so I better go short. If I'm going to place a trade in this particular, looking at this chart as it is, I would say, you know what? It's time to go short. And do so accordingly. Now, what changed this was we had the NABU house numbers, which is I guess the housing association numbers, if you will. It met expectation, didn't exceed it, but it met expectation. Yeah, I think if it didn't meet expectation, this would have probably went down even lower, but it met expectation, and it happened right around 10 a.m., 10:02, and look what happened. But it also gives you some insight if you're a trend trader. Again, the more I have, if I were to take a look at the high of 88.37 versus the low, this is very significant. And it's telling me that the lower it goes, the more of a trend is going to be on the upside going the opposite direction. And in fact, that's pretty much what we saw right here. I mean, it just...
You recovered the whole move and then some.
Exactly. It just took right off to the moon. So...
And I see in your Darvas box, the first lower low doesn't hit until the very right end of your screen there. Actually, in the new up move. So in the down move, it was very consistent. Lower lows. Oh, I'm sorry. Then higher lows. Lower, 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 lower on the and then you have consistently higher lows on the move up. Yeah, I'm not a Darvas box trader, but I'm glad you put that on my radar because I'm going to start plotting them and getting my eye accustomed to them. There's your first lower low. You just passed. Yeah.
Yeah. I mean, basically, this is a very good and unique tool to say, okay, now if you take a look over here, you see a pullback right around 10:34 a.m. Right? You see a bit of a pullback over here, but the WOW index is still green. Sceeto, McDaddy. I mean, they're all turning green. It's telling you that this is temporary. It's not long term. It's not the beginning of the end. It's not another down move, etc. So just hang on.
Yeah.
And
you make a good point with the McDaddy. Like the McDaddy over here is pretty powerful. You'll see a lot of buying right in the hole there. A little bit of red, 2 spikes of red, and then consistently. And then you'll see that bolus right there of those 3 bars. And every time you see resumption from red to green in McDaddy is often a very good place just to get into a trend or a move because that's telling you that the order flow is back in confluence with the primary trend.
There you go. There you go. And you can see the result right here in terms of what happened, which is again fairly significant. So I mean, these are the things that that any trader could utilize. And again, you know, for myself, I kind of like to use market correlation as the confirming factor. I mean, I look at it from a point of confirmation, because if I'm seeing this and I know that if this thing is increasing, that if the 30-year bond is going up in value, crude has to go down. I mean, and that's just normal market conditions, etc. You see over here, now take a look at this. You see over here, we've been talking about what happened after 10 a.m. After 10 a.m., it went to its high, 10:15, okay? Went to high at 147.02, and then look what happened immediately thereafter. If
So
this
Nick,
thing is going down, it means that crude has to go up.
so now Nick, these markets, let's say, are correlated, but one definitely drives the other. You're saying changes in crude price are not going to change the bonds. You're just saying the bonds are going to change crude prices.
That's correct, yes.
Okay, thank you.
Yeah, that's correct, yes. Because typically crude trades to the opposite of what the financials are doing. Again, it's really the financials that are controlling a lot of things that we see. Fundamentally, anyway, not technically, but fundamentally, it seems as though the financials are really the key to what goes on in just about not only the futures market, but I would also suspect in equities as well. I don't trade equities. I haven't traded them in quite some time. I'm pretty much a futures trader because I just don't like the idea of, you know, quarterly earnings or things of that nature, which in the futures market we don't really have to be concerned about. There's no quarterly earnings on crude. There's no quarterly earnings on, you know, the U.S. dollar or the 30-year bond or anything else. So I don't particularly like that aspect of the equities market, if you will.
Now the crude, though, they do have your weekly inventories. Do you trade the weekly inventories, or do you steer clear of the weekly inventory number? I generally stay clear of it, all right, because what I like to do is I like to look at the aftermath of what happens after the number comes out. I don't recommend that anybody be in a trade when the inventory number is posted, because the market just acts very erratically. It just doesn't make very much sense. It's not really any kind of a trend. It can go up and down simultaneously. Now, I've known some traders in the past who will trade crude during the inventory release numbers, and they'll go, you know, long and short simultaneously. You know, sometimes you could pick up something with that, but sometimes you could wind up with a double-barrel loss, whereby it goes up initially and then just drops down, or vice versa, and your order could be placed, you know, for both going long and short, and you can wind up very much on the short end of the stick, both ways. So I've seen that too. So that's why, for me personally, I don't trade the inventory numbers. I concur. I think you're better off. Like, there's too much volatility. There's too much erratic information. There's plenty of other opportunities. Why put your capital at risk or undue risk in the market?
Exactly.
There's other safer places to pick up. You know, and again, like, I really believe day trading is a very conservative way to make money. And you could be very risky at day trading and throw the rules out the window, and then day trading could be very risky. But if you use your stops, if you know what you're doing, it's a very conservative approach.
Well, and not only that, you know, the other great thing about it too, Carl, that I found is, you know, I like the idea of going to bed at night knowing that I don't have an exposure or anything.
That's huge.
If you hold on to equities for any length of time, you know, there's always a concern in the back of your mind, you know, are they going to report lousy earnings? Is there going to be some malfeasance going on? Is there going to be some scandal going on? I mean, we saw this 10 years ago. You know,
and we're seeing it again today, yeah.
World. You know, I mean, you know, we've seen this time and time again, where you know, our capital is very, very much at risk in that regard. Me personally, you know, I like the idea of sleeping well at night. So I don't want to be long or short anything from that perspective.
You know, Nick, I'm with you that way also. Like,
yeah.
I saw a great blog article the other day about these magnificent stocks that somebody bought 10 or 20 years ago. You know, it was Broadcom, Nortel, you know, all these wonderful names that were killing it, and now they're either defunct or gone or worth 10%. Or even Oracle's only worth half of what it was a decade ago or so. So it's a tricky market.
And if you want to, I know, and if you want to think about things like, you know, for example, Sun Microsystems, which ironically enough Oracle now owns, okay? Sun Microsystems, I mean, that thing was like well north of $200 a share at one point. Then they offered a 2-for-1 stock split, and everybody went bonkers buying it, it fell off the side of a cliff immediately thereafter. It's like you don't really know what's going to happen with those types of things, so why tie up your capital for that length of time? Because it could be worth significantly a lot less than what you paid for it. This, you know what it is you're dealing with on a day-in, day-out basis. And you know as a trader, you know you tally your wins versus your losses. And you know what? If you came out on the plus side of the column, that's a good day.
That's a good day.
That's a real good day, you know. Nothing to complain about. Nothing to kick about.
Nothing to kick about. I noticed, can I ask you a question about your chart here? This is a crude oil chart. You have a lot of crude oil algos on there. But in the lower pane, you have an S&P algo. Why do you put the S&P wind on a crude oil chart?
Oh, the wind. Okay. Again, basically, it's kind of a barometer, if you will, in terms of what the equities market is doing. All right. There seems to be a lot of significance, if you will, between the crude oil market and what the equities are doing, and it could be either the S&P, which is listed here, or it could be things like the YM, the Dow Jones Industrial Average, etc. But there also seems to be some correlation between crude and what the general equities markets are doing.
Connection
General
lost.
equities markets appear to be going up, and it's almost likened that crude will go up. And the reason for that is because crude is a very good barometer in terms of what future business activities would look like. In other words, if future business activities appear to be bullish, then typically oil is going to go up in relation to that, because as the general overall economic conditions improve, and the price of crude goes up. It follows that, right? And that just seems to be the thing. I have it listed there because it kind of gives me somewhat of a barometer as to what's going on in the equities market without my having to look at it, constantly or switching back and forth.
Awesome. All right, Nick. Well, I want to thank you for coming to Talk and Shop today, and maybe we could do this again.
Yeah, I'd like that, Colin. I thank you very much for the opportunity of doing that and the opportunity of addressing, not only the Sceeto users, but whoever else comes upon this.
And your blog, Markettealeaves. How often do you update that blog? Do you update that more than 3 or 4 times a week?
I update that every single trading day, Cole.
Every trading day, and that's why I put it out there. Just so folks are listening, Nick is a machine. That thing gets updated. I think, what time do you push the button? What time does that generally release by?
Oh, it could be anywhere from between 4:30 a.m. to maybe 5:30 a.m. in the morning before the market opens.
And just so folks know, Nick is talking Eastern. That's Eastern.
Yeah,
so if you're an early riser and you're hitting your decks, and you want somebody to have already crunched the numbers and done your intermarket relationship analysis for you, it's there on Nick's blog every morning. He's a machine. He's very disciplined, and it's a great resource. So I thank you for coming on, Nick. I want to stay in touch, do some more of these, and good luck with that blog. I hear that more and more people are picking up and want to syndicate your blog. So really, good luck with that. I think you deserve it. It's a great resource for traders.
Thank you, Colin. Appreciate it.